Welcome to LeaderOne Live, where we bring the experts to you.
Welcome back, everyone. Here we are with LeaderOne Live, Episode 8. I am your host, Alice Lend. We have two special guests today. So first, I will introduce Todd Ledden. He is our Chief Capital Markets Officer and a regular here on LeaderOne Live, as well as a newly published author of Protect the House, which is a comprehensive mortgage guide to capital market strategy. And we're going to be hearing a lot more about Todd's book here, in the days and weeks to come. So welcome, Todd.
Thank you.
Yeah, good to see you.
I always look forward to chatting with you and trying to inform people about stuff that is kind of nerdy and not fun sometimes.
Absolutely. And you actually came to me to suggest we have our special guest, David Porter, on today. David Porter is with Vista Point Mortgage. He has brought a closed-end second to LeaderOne's product offering, which is a great product. We're going to talk about it today and how relevant it is and how many opportunities there are in today's market to use this product, especially with all of the clients and consumers that are holding on to those low-rate first mortgages. So Todd was really passionate about this product and integral in bringing it to LeaderOne. So I'll let you kind of introduce the journey to bringing Vista Point and David on today, Todd, and a little bit about how you feel about the product and why you thought it was important for us.
Yeah, thank you. So as we all know, in 2020, there's massive refinance boom. Everybody and their grandma and their mother refinanced their properties at really, really low rates. And then 2022 hit and the Federal Reserve got spooked with inflation and dramatically increased rates. And at that moment in time, it was tough, 2022, right? Because a lot of folks they're still locked into their low interest rate mortgages and they're not moving. And we're not seeing the same supply that we normally see based on the dramatic changes of Fed policy and quantitative easing and all that good stuff. And so in 2022, when I started realizing I was hearing stuff about the equity that borrowers have, right? And it was dramatic how fast increases in home values were occurring. And at the same time, it was hard to pay. It's still hard to pay bills. Inflation's something it's 2% at 2% at 2%. It's compounding. And that's partly why you're seeing home values increase the way they have. And I wanted to bring a product on, and I worked with David Porter in the past. And he's definitely a go-getter in the industry, and I have a relationship with him. So I talked to him, and we looked at data. We worked together to finally get the board of directors at LeaderOne to be okay with doing some closed-end seconds. And so here we are today. We have done some business. We did some business in 2024, but I'd like to continue to promote this opportunity for loan officers and borrowers. So I'd like to hand it off to David.
And David, why don't you start by just telling us just a little bit about yourself, and then we can kind of get into your product.
Sure. David Porter with Vista Point, correspondent, Eastern Regional Manager, cover half the U.S. on our correspondent division side. Vista Point's been around since 2019. Major focus on non-QM, second liens, and HELOCs is our product specialty. And trying to help lenders create a program set that compares to what they want to originate internally and what their LOs want to originate internally. So we really are coming alongside our clients to create a specific product within a product. Even though we can give you everything, not every shop needs everything. So we tailor that experience and the product set very similar to what LeaderOne has done with the seconds. And going back, been in the industry since 2011. And I've been in correspondent lending since then. So various roles of operations to sales leadership, even just being an account executive, a lot of passion that comes from me being able to help lenders understand products, how to scale it, how to grow it, and then more is helping the LO understand why these programs are important, not only to their business, but to their legacy that are leaving behind as LOs as well.
Yeah, and we had a little chat before this call, and I know that when you and Todd were looking into this product originally, took a little bit of a dive into LeaderOne's just lead base, or maybe it was just closed loan base, but you identified potentially even at that time maybe 5,000 or 6,000 clients that could potentially benefit from a closed-end second, and these are clients that probably closed, like you said, in that 2020 to 2022 timeframe. So tell us about, I guess, maybe several of the most common uses for this product, and who it really would benefit from it.
Yeah, honestly, the number one question we get at Vista Point, and I'm sure a lot of the lenders, now that closing seconds become more of an IMB program than ever. It used to be a heavy bank credit union type product, and now that we brought it into the IMB space, along with many other investors, a lot of LOs just aren't used to it. They're used to either brokering it or at least having it sent off to a local bank or credit union to help that borrower. And now, at a crucial time in our industry, when we want to say yes to every deal possible, and then be able to help the LOs understand and give them the knowledge to be able to have this conversation with the borrower. In the past, they just wrote it off to the bank. It's kind of crucial. And the best way to do this is understanding what you're originating currently today at your company and what you've historically originated. And Alice, you hit the nail on the head. We did a big deep dive into the past production of LeaderOne to analyze, okay, what type of agency borrowers have you originated, jumbo borrowers, was there non-QM in there, was there DPA programs, and doing all that, and then really going through that list to come up with a specific formula for these types of borrowers in this bucket will fit the mold for a closed-end second. So you already have your lead generation within your LOS at every company. You don't have to reinvent the wheel. You don't have to find new borrowers. It's just a great product for LOs to use to just touch base with the borrowers. Every LO should be touching base with the borrower all the time anyway. But this has been, number one, getting phones to ring. Number two, getting the loan officer to make outbounds when business has been tougher to get over the last couple of years. Reigniting those conversations with referral partners, past borrowers that they thought when doing a refinance or a purchase at 2%, 3%, 4%, they'd never touch again and be able to keep in their mortgage ecosystem again. And now this is a reality. So that's where we focused very early on with all of our clients. And then the success stories come from there. Anywhere from, how are you using the product? Are you using it for primary, second home, or non-owner use? What are you, as an originator, originating mostly of? We've had conversations with LOs that focus on the investment borrower. So this has been a very good way to help investors grow their portfolio program and agenda by pulling out equity while still maintaining that low rate on their investment property. They're all about cash flow, right? They don't really care about the rate as much as they care about cash flow. So it's really been able to help that borrower.
Yeah, I wanted to make a point where, prior to this 2022 and this massive increase in equity, it made sense to do just a cash out refinance, right? And that strategy has been in place for a while. Whereas this is a different strategy where you got to think about a blended rate between your second and your first. And lots of times that blended rate is advantageous versus just you're doing your typical cash out refinance. Of course, doing a full cash out refinance for the first, there's profitability there. That's pretty nice compared to seconds, but we got to think about the borrower in this perspective, right? So this is a fantastic way of being able to provide funding and equity back to the borrower's hands. So
and an opportunity for the loan officer we're thinking about the borrower and able to make money on originating a second, because in the past, just having that HELOC option, and has been hard for us to compete at times, with maybe a bank HELOC, being able to offer this as an alternative. And I know we talked about this, but, insulating your clients and providing them the option rather than just, I've heard many originators say it. Oh, you might want to check with your bank on a HELOC first. This product has a lot of great, uses that, of course, HELOCs aren't going to have. The non-owner occupied properties, credit scores under 700, and just the opportunity for the loan officer to make comp. And David, you said, the loan amounts go down as low as 50,000, but the average is somewhere between 1 and 200,000, and the loan to values once those loans are done, on average are still in the 60 to 70% range. Is that accurate?
That's correct. We've originated a little over $1 billion and closed in second since we launched this product set out to our client base in November 2022. And our average borrower sitting at 68 LTV, average loan amount's 191,000. And then we have, multiple different aspects compared to like some other opportunities out there, like banks and credit unions, they may not touch an investment property. So, right. Since we offer the non-owner, that offers an opportunity to go higher in loan amount. Our loan amounts go up to 750,000 now. So there is more and more help like the jumbo borrower. The jumbo borrower is also stuck in a lock-in effect. They might have a larger outstanding balance and they don't want to refi in a low rate, but they have even more equity they want to tap into for very different reasons. If you look at the overall equity in the market, Federal Reserve stated it was $32 trillion at the end of last year. That's a huge number with a T, trillion, right? In 2020 and 2021, there was about $8 trillion, a little bit plus or minus of volume done in our industry, which were record years, right? 32 trillion is an astronomical number. There's plenty of equity out there to help every company be successful at this product set, to help every borrower that needs an alternative to a first lien cash out. And not every borrower is going to fit that mold, but there's more borrowers today that are grateful that they can tap in their equity while preserving that low rate and payment on their first. So a lot of great opportunity. It helps the LO out, helps the borrower out, and helps the company out. And all three make this mortgage world go round, right? So everyone wins with this product set.
Yeah. And I mean, you're talking about $32 trillion in equity. I think the last I checked, and it's been a few quarters ago, but the credit card debt in our country is over $1 trillion now, I believe. So, I mean, and talking about blended rates, credit cards, the rates are, through the roof. Auto loans are expensive. And I think just, being boots on the ground, you get a sense where, there's a pride factor and there's a feeling of, financial responsibility that the customers have, and they want to hold on to that 2 or 3% interest rate. And I get it. I mean, of course they do. Right. But the world got really expensive after everything was really cheap. And so a lot of those clients, especially maybe higher debt to income ratios, and then people that maybe went into that home purchase during that less expensive time in the country that already had debt, checking in with them and giving them a solution that feels financially responsible to them, that they're not like, kind of letting go of that first, and just giving them that opportunity to make a good financial decision and save themselves money on a monthly basis and have an amortized loan too. Maybe versus the HELOC where they're just paying interest only and it's going into the abyss.
I'm going to take it a little farther, Alice. Like, you talk about like the borrower and the pride that they have with that lower interest rate. I feel more like they have to have that rate in this inflationary environment. It's almost not even a pride thing. It's like they need it, right? And they need to keep that low interest rate financing in place. But
right.
They still need some sort of help.
They need help. And they feel like, what am I going to do? Because I don't want to refinance. Like, what do I do with this?
What do I do? I have all this money. I can, even if they were to downgrade, right, and go into a smaller home, there's the savings that they have on that first right now is huge. Like you could downgrade and you're still going to be you're not necessarily going to save, right? Because prices of homes are up, right? It could be higher on a lower, less bedrooms in a house that it just won't work. So
yeah, I had a client last week. She was a single mom, or she was becoming a single mom, and she said, this is what my payment is right now. But she was trying to figure out a way to save money, and it was like, rent was going to be more expensive than her mortgage payment, and she would have to go way down and over $100,000 in purchase price to even remotely come close to saving. So yeah, you're right, Todd. I mean, that is we want them to be able to hang on to those loans, while still having an opportunity to reset their consumer debt or remodel their kitchen. That's expensive.
So, some stats here that I would love to share just to kind of like why this is starting to pique a lot of borrowers' interest, right? So if you look at Mortgage ICE, ICE came out with a survey, and they were able to do a pool that the average borrower sits on $319,000 in equity in their home, and $207,000 is tappable. And a lot of that equity has been experienced over the last 5 years. And obviously that was COVID driven, low rate driven, borrowers buying homes at record pace in 2020 and 2021, overpaying for homes or bringing more money to the table. There were bidding wars, etc. There was a lot of movement in the U.S. as well. But all that to be said, in most metros, home price appreciation continues to grow, which means their equity continues to grow every year. But what we're also now experiencing is insurance is changing, taxes are changing, HOAs are changing across the board. So even though an HOA might have gone from $300 to now $500 or $600 in condos in Florida, or insurance in certain areas with these catastrophes that we've been dealing with over the last couple of years or even more years, and insurance companies pulling out, insurance skyrocketing, they have to keep that low rate payment on their primary with the principal and interest they have. They don't have a choice to go up to the 7% just to be able to make the payments and still stay in their home. So the second has been able to not just help in a major time of need for borrowers that are debt consolidators or have overspent, et cetera, but also have helped those borrowers. They have to maintain that low rate and payment on the first because other areas in the economy have changed, like taxes, insurance, and HOAs. So they're pulling out that debt to pay off, pulling out that equity to pay off their debt, to also help cover costs that are rising in some areas in mortgage as well. So if you had the average borrower sitting out there with $207,000 tappable equity, just to give you some stats, about 80% of those borrowers are looking for some type of debt consolidation, and 20% are looking from either renovation standpoint or purchasing other property. So they got this primary they love. They're looking to buy a second home. They're looking to buy an investment property. They're cashing out equity in their home because it's much cheaper to do that, use that as down payment funds to then go buy a second home or investment property or buy the property outright so they don't have to deal with a mortgage. Mm-hmm. So you really had this kind of process right now happening in mortgage where you get some borrowers that are needing their equity for one thing, and then a completely set of borrowers that, hey, job's good, income's good, savings good. I just want to leverage my equity because I want to invest more or I want to buy another property. Completely different type of conversation, which is what we help prepare the LOs to have with those specific borrowers by doing the exercise we did at LeaderOne, right? Understanding what type of borrowers need the debt consolidation, what type of borrowers need to be talked to about renovation. With the lock-in effect that we're seeing at 2% and 3% and 4% rates, borrowers are staying in their homes a lot longer as well. So that means they're more apt to renovate. They're more apt to add an addition. They're more apt to add a pool in the backyard and make it their oasis, or buy a second home because they're going to be snowbirds, half the year and still maintain that first home. So a lot of ways you can pivot within this product set. It's not always just cash out for debt consolidation. It can be for whatever you want it to be as an LO.
And what a great opportunity. So, I mean, if you were originating in those years, you automatically have a lead base right there. We talked about that. So it's just a touch point. And yes, we always should be contacting, anyone we've done a loan for, anyone really that we know or that might have transacted during that time. It's a great opportunity to, do an email campaign, go on social media and talk about this product as a call to action to reach out. And if you're even newer into origination, then, it's just a great talking point because it is, I think, one of those products that really consumers don't know as much about and aren't going to necessarily seek out, but that might be the perfect solution for them.
Yeah, the top three examples that we see coming in the door is debt consolidation, is investment purchase. So they're using money for investment down payment to expand the portfolio. And then also jumbo borrowers. Jumbo borrowers are in the same scenario as your average conforming borrower, just higher loan amounts. And they either might have higher amount of debt or they're completely trying to finance something very different in their lives than the average borrower, maybe putting a full renovation, pulling backyard as we discussed earlier. But those loan amounts at $1 million, $1.5 million, because we do combine lien amounts up to $5 million, are usually larger for the jumbo borrower. Those borrowers want more equity. They're using their equity to employ into their business, to buy a business, to maybe finance a big vacation. Who knows what they're doing with their equity, but they're doing things very differently than debt consolidation when you're dealing with higher loan amounts. Also, some stats to keep in mind, because we talked so much about your past book of business. As of August of 2024, if you look at what the Redfin and New York Times research did, 85% mortgages, first lien mortgages sit at 6% or lower rate, and which is crazy. But then if we go down further, 76.1 sit at 5% or lower. Our sweet spot to make sure that we're getting the best payment, the best bang for a borrower's buck, and whether or not it's a first lien cash out or a second lien cash out, is around that 5% range. So we see more borrowers at 5% or lower opting for a second lien, close in second, or a HELOC or some type of equity vehicle over a first lien cash out to preserve that payment. But 57.4% of borrowers sit at a 4% or lower rate. It's going to be a long time before we see 4% rates, 3% rates, or get down to a point where borrowers are like, okay, what's my threshold? Am I have to be 150 basis points above my mortgage, my current mortgage, to feel comfortable going up to from a 3 to 4.5, or from a 4.5 to a 6? What is that threshold that borrowers seeing? And everyone has kind of a different line.
Yeah, and that's where that like blended rate pitch comes in really nicely, because if somebody's at 3 or 4% and you're giving them a second that's maybe half the size of their first, and you can say, what if I can help you meet all of your goals, and you're under 5% on your blended rate? What a great conversation to have.
And you guys have a tool that
we do have a tool. If you go to blendedrate.com, you do have the ability to go there and pretty much key in information around your first lien payment and rate and loan amount, outstanding balance, and then the second lien information, and then compare that to a first lien cash out with today's rates. And what that will give you is the blended rate of the first and second together compared to a first lien cash out, which we can blend rates down into the low 4s, low 5s, depending on the borrower situation. So you can use that as a tool to have the conversation with the borrower, like, hey, here's how much you're saving just on principal and interest over a first lien cash out if you just did the second. That doesn't even include all the costs and all the debt that we're reconsolidating back into the second lien anyway. So there's a true amount of opportunity discussed in the blended rate. But personally, if you just take blended rate out of it, most borrowers may not understand that. Just talk about payment. Right now, we need to talk about what your first payment is and your second payment is together compared to what your first lien cash out payment would be. The difference, the delta between those two payments is what that borrower's actual value of savings is over the first lien cash out.
And then with the first lien, they're starting amortization all over again, right? With interest.
Yeah, they would be starting amortization all over again. Yeah, correct. We've driven down the cost for second liens too. So first lien costs could be higher compared to a second lien. We do things like have a lighter title on second liens. We drive down the cost by being able to potentially do an AVM model versus a full appraisal model, which drives down the cost for the borrower in transacting these types of loans. So the cost benefit as well from loan to loan could be lower on a second lien compared to a first lien too, to grab that cash.
See, Alice, I can speak loan officer talk too, right?
You do it very well. Well, thank you so much, David and Todd, for coming on today. We'll make sure, David, that we've got your contact information attached to this episode here so people can reach out if they have any questions. And of course, we've got your contact information here internally at LeaderOne as well. So this was great. You guys.
Thank you for having me.
Yeah, David, I really appreciate you, taking the time and talking to our folks out there. Very much appreciated. And it's part of the reason we have relationships, right? In this market. So thank you, man.
Originators, we're all in this together. So our job is to go out there and spread the word and to contact our people and find the people that this product is really going to help and make someone's day. So thank you guys so much. We hope to see you again soon. And thanks again.
Thank you.
Greatly appreciate the partnership. Thank you.